Welcome to this video, which is all about the best Forex trading strategies for success. Now, which are the best strategies that actually work? Which would be the best one for you in terms of your personality and your investment aims? Well, in today's tutorial, I've got an hour-long seminar which was held by Jack Schwager to discuss the techniques of the world's best traders. And Jack Schwager, if you haven't heard of him, wrote the classic books The Market Wizards, The New Market Wizards and Hedge Fund Market Wizards, where he discussed with the top traders themselves how they made money, not just in terms of method and strategy, but also in terms of their mindset and their psychology. Now, what you'll learn coming up is there is actually no best strategy that stands above any other. There's plenty of different ways of making money. Your personality will have a lot to do with the strategy that you pick, and you'll also learn that Forex trading is really a psychology game. And it is. Anyone can learn to trade Forex, but very few people can get the right psychology and win. Now, getting the right psychology, the right mindset is actually just a choice. And, when you've seen this seminar, you'll see why Forex trading is actually very simple to learn, why so few people actually end up making money, and how you can trade successfully if you do your homework and you adopt the right mindset. So without any more introduction from me, here is Jack Schwager discussing the best strategies, techniques and psychology tips from the world's top traders, and I hope you enjoy it.
Thank you. It's great to be in front of a crowd of which is almost pure traders, I would assume. First thing I want to say, even though most of you are traders, I assume probably a lot of people here do something else in their for the regular profession. Also, probably some spouses got dragged along unwillingly. So to make this talk relevant, I can assure you that all the points I'm going to talk about, really all the points, apply not only to success in trading, but to success in general. So that's the first thing. Now we'll start out with what's not important, because people think that trading has to do with some sort of secret formula, some magic, whether it's Elliott or Gann or anybody else. You find a formula and you'll get rich, and that's what success in the markets is about. And I think it's really a very wrong way of looking at it. And let me illustrate it by giving you a couple of examples to make it absolutely clear. We'll take some individuals. First, we'll start with Jim Rogers. Most of you, I assume, know Jim Rogers, the fellow with the bow tie. Used to work with George Soros running the Quantum Fund back in the 70s. It was the most successful fund at the time. He quit because he got tired of the management aspect. He's been investing his own money for the past couple of decades very successfully. Brilliant guy. If you read my interview with him back, which was done now about 13 years ago, all of his projections were exactly right. He was talking about the top of the Japanese stock market right before it topped. He talked about it going down, the Nikkei going down from 30,000 plus at the time. He said it would go down to 10,000. Incredible projection. He talked about gold at the time going down for the next 10 years. Every projection you look at, he was exactly on. Okay, so he's basically a fundamental analyst, but I asked him, Jim, you ever look at charts? And he says, like he's admitting a sin. He says, do you mean if I just look at it just to see where the market's been? Yeah, I'll look at it. But do I believe in any of this head and shoulders, mumbo jumbo garbage? No, it's all nonsense. And he says, I've never met a rich technician. And then he pauses to be cute. He says, unless you count the ones that sell their services. So I don't know if you can get more cynical. I don't know if you can get more cynical about technical analysis than Jim Rogers. And for Jim, a short-term trade's like 2 years. Okay, that's one side. Other side of the fence, take Marty Schwartz, who's a stock index trader. I interviewed Schwartz. It happened to be coincidentally just the time he was putting together a track record. And a lot of these traders, they trade their own money. You don't actually get the luxury of having their track record per se. In this case, he was thinking of managing public money, so he had to have an audited track record put together. She gave me his 10-year track record when I was doing, before I did the interview. And over that 10-year period, Marty had compiled an average return of 25%. Now, usually I say that, the audience doesn't seem to be very impressed. So let me clarify that. 25% per month. All right. Now I've got your interest. Okay. Now, some of the quantitatively oriented people in the audience are going, wait, 25% a month? How come he didn't own half the US JNP? Right? That really compounds. Well, Marty's father went through the Depression and instilled in his son a great fear of things going wrong. So Marty, even though, and this you can go back, you look at he was doing these trading contests with real money, not these hypothetical contests. He's putting in $400,000, turning it into $1.2 million in 4 months, going back, putting the profits in T-bills, going back to 400. He kept on doing that for 10 years. He kept on going from 400 up to over $1 million and back down to 400, and kept on putting the money into T-bills because he had this fear of something going wrong. So that's why he still made a lot of money, but it didn't compound to God knows how much. Anyway, Marty, talking about technical analysis, is paraphrasing people like Jim Rogers. And he says, I never met a rich technician. You know, what a stupid, arrogant type of attitude. He said, I spent 10 years on Wall Street as a fundamental analyst. I lost money every year, and I got rich as a technician. So you really can't get much more different than that. And I'll give you another slant like Marty Schwartz. And this is a fellow by the name of Ed Sakota, who would be totally unknown were it not for my first book. I mean, I had never heard of him. The way I found Ed Sakota was there was a fellow by the name, also not a well-known, not a completely unknown person, not only well-known, Michael Marcus, who's a very private individual trader, who I happen to know actually just by coincidence. My first job on Wall Street as a research analyst happened to be this job slot he was vacating. And so we met, we became friends, we kept in touch. And so years later when I was doing the book, I asked him to do the interview. Why did I ask him to do the interview? Because, well, he went off to be a trader. He went to Commodities Corp. They gave him a $30,000 account. 10 years later, it was $80 million. So that's why I asked him to do the interview. Now, so that's a pretty impressive record. And he was really reluctant to do the interview. And finally was able to convince him to do it. And I flew out to California and interviewed him, spent the day at his house. We really interviewed all day long. And after dinner, he pushes back his chair and he says, you know, this really wasn't bad. You know, it's kind of a cathartic experience. And he says, you know who you should interview? You should interview Ed Sakota. I said, Ed who? He said, Ed Sakota. I said, who's Ed Sakota? Well, he said, Ed is the best trader I know. Now, if you're doing a book on traders and some fellow who's turned 30,000 to 80 million is telling you about the best trader he knows, obviously you're interested. So I said, well, can I speak to him? So he says, well, you know, sure. So he calls Ed and talks to Ed and gives me the phone. I was supposed to head back to New York, but you know, Ed agrees to do the interview. So I say, well, I'll change my plans. I fly out to Nevada. And my original intention was to actually get back the same day, but it turns out I ended up spending the night there and just talking to him all evening. But in any case, Ed Sakota and I kind of see each other every number of years. We end up in the same place. And back about 5 years ago, we were both in Chicago at the same time. We had dinner together, and he was telling me tongue-in-cheek about a dinner he had the previous evening with a fundamental analyst. And he says they went to one of those Chicago steakhouses, you know, the ones with the big steaks and huge knives. And the fundamental analyst is cutting his steak, cutting it a little too aggressively apparently. And the steak knife flips out of his hand, twirls in the air, and they're both watching and lands in his shoe. And Ed turns to the guy and he says, why didn't you move your foot? And the fundamentalist looks back and he says, well, I thought it was going back up. Okay. You get the idea. Cynicism, right? So what I'm trying to do, I'm trying to give you people here who are phenomenally successful using pure fundamental analysis on one hand and complete disdain for technical analysis, and people who have been enormously successful using pure technical analysis and complete cynicism about fundamental analysis, right? So you can't get further apart. It's got to tell you one thing. It's got to tell you there's no single way, there's no single road, there's no single message. If you're looking for that, you haven't even got the right question, let alone the right answer. So I'm going to quote myself. I don't quote myself very often, but I will for one time in this talk. And in one of my books, I used a line because I think it applies to this. And I said, there's a million ways to make money in the markets. And they're unfortunately all very difficult to find. But there are many, many ways. So the first thing to realize is you have to find a path and not to find the path. Okay. That leads us to the first principle. And if you take nothing else out of this talk, if you just take this out of it, it'll be worthwhile, I guarantee you. And that is every trader I ever interviewed, I could say this about. They found a method that fit their personality. Now, some of you may say, well, doesn't everybody do that? I mean, it seems logical. Wouldn't you trade your own? Well, no, you really wouldn't. Think about it. If those of you who are traders, you probably could think of examples right off the bat. But I've known certainly traders who may have had, let's say, a good knack analytically and could have done really well putting together some systematized approach. and traded it, but no, too boring. Or no, they have to second guess it. Or no, they have to be more involved. Or it's too slow, or whatever. Or you have traders who are really good on the floor. They got the real instincts, but they get tired of all these fellows up in the office trading 10 times as much as they are in all these markets, and they want to be one of those guys up in the fancy office and so on. And they go do that, and they become a mediocre trader off the floor. You constantly have people doing things which are not fitting to their personality. Now, let me illustrate what I mean by trading to fit your personality. Again, let's take specific examples, specific people. First, we'll take Paul Tudor Jones. Paul, one of the great future traders, of our time, and particularly in his initial years when he was managing small amounts of money, just had some incredible, a decade, 10, 15 years of incredible performance. When I interviewed him, he said, come to my office at 2 o'clock, And I said, I knew he's an active trader, so I said, well, Paul, I can come after the market closed, no problem. He said, no, come 2 o'clock, it's fine. Okay, come to his office, big office, screens all the way across the walls. He's got speaker phones that directly connect to the floors. He got regular phones. He got people bringing him messages. He's yelling out, sell 300 March S&P, buy 500. All during the interviews, selling and buying, and people, and phones are ringing, and everything's going on. He's looking at the screens, and he's doing the interview, okay? So I kind of say, like watching Paul trade is sort of like watching a professional tennis player on speed or something like that. I mean, he's just like really active and aggressive. That's Paul. That's his style. That works for him. Let's take another picture. Gil Blake. Gil Blake is a mutual fund timer. When I interviewed him, he had a 12-year track record, average returns of about 45% per year. Very steady. His worst year was like plus 35. His worst was plus 35. His best was about plus 55. Never lost more than 5% from a peak to a valley. Very, very consistent trader. What did he do? He actually, interesting way he got into the markets. He was a financial officer for a firm, knew nothing about trading or investing, and a friend of his came in one day and said, "Look, Gil, I found this. I've been timing mutual funds, and I've got this little pattern that I found, and it works." And Gil says, "Nonsense, nothing that simple is going to work. Give it to me." And so he took the numbers and he went over it, and it worked. He couldn't find anything that was really wrong with it. And that got him intrigued. Then he started really looking at it more closely, and he came up with patterns that were really much more effective. And he became so convinced that there was something there that he quit his job and he became a trader, which led to the performance record I told you about. He would go to the library. He didn't even use a computer to do his work. He would go to the library, look through microfiche, look for all these mutual fund prices, and look for patterns. And just spend weeks in the library just flipping through these price patterns. Now, and he'd go back and he'd be trading out of his bedroom at home, and that was his style. No other people, no other phones, no computers, nothing. That's Gil Blake. Now, could you picture Gil Blake in Paul Tudor Jones's office? Could you picture Paul Tudor Jones and Gil, going through the microfiche? I mean, it just is such a contrast. And if either one tried to do the other, they would absolutely fail. So you have to find a method that fits your personality. That message, by the way, also leads to an interesting tangential observation, and it's why most people will be doomed to fail trading a system they bought. And if there are vendors here of systems, I apologize, but it's a reality. Now, why is that true? I don't know what % of trading systems are profitable. Maybe, I'll grant, let's say even more than 50% are. Let's just take that as an assumption. The trouble is this: every trading system, I don't care what it is going to hit periods where it's not going to do well. Now, if you buy a system, particularly if it's a total black box, and you don't know what's in it, you didn't develop it, it has nothing to do with your personality, the first time that it hits a bad period, you're not going to have faith. You're going to lose it. You're going to drop it. And that's why invariably most people who buy systems end up losing, because they will stop using it when it goes through a bad period. It won't be there when it recovers. Again, it has to do with trading what matches your personality. There is a Wall Street adage that goes something along the line: even a poor trading system could make money with good money management. Have you heard that before? You got that? Okay, if you have that, forget it, because it's really one of the stupidest things that has ever been said. Okay, I'll illustrate that. If you believe that, then I invite you to go to Las Vegas and go over to a roulette wheel and use your best money management system and see how far you get. And in fact, if you were to ask 100 mathematicians the following question: I'm going to play roulette, what betting strategy, what money management strategy is going to be optimize my results, they all should give you the same answer. You know what the answer is? You have, let's say you have $1,000, you walk over to the roulette wheel, pick red or black, put it all down, bet once, win or lose, walk away. Those are your highest odds. Now, yes, they're less than 50-50, but only a little bit. But the longer you play, the more your odds go down. So if you don't have, and here's the point, if you don't have the edge, good money management is actually the epitome of bad money management. You actually bet it all at once, because anything else you lose, you have a higher and higher probability of losing. So it's not enough to have money management, you actually do have to have an edge. And having an edge means that you have a method. No trader I ever interviewed, when I asked them, how do you do what you do, some explain it actually very, very explicitly, some more generally, but they all have some specific type of approach. No trader ever said, well, you know, I wake up and I look at the screen and if bonds look good to me, I'll just buy them. I mean, nobody had a cavalier shoot from the hip approach. They all had specific methodologies. That's essential to a winning approach. The next thing we come to is the concept of hard work. It is amazing how workaholic-like these people are as a group. And I can give you lots of examples. In fact, most of the people would fall into the category. I'll take one example out of the most recent book, and that's David Shaw. Very secretive fellow who runs this hedge fund, which is a statistical arbitrage, I guess, to put it into a category. What they're doing essentially, and he's been running this fund now for about 13 years, excellent results. And what they do is they trade literally about 10 different all the major world markets. They're monitoring all the equities, all the derivatives, and they're running about probably 20 different mathematical models simultaneously and looking for tiny mispricings, and it's all working interrelated with tremendous computer power. He has scores of the best PhDs in mathematics and physicists and computer science working for him. It's an incredibly complex, sophisticated approach. I mean, extraordinarily so. You would think that monitoring this and supervising this and working on this would be enough, but no. David Shaw, over the years, has also been developing companies. Probably one of the better, I mean, quite a number of them, which he then spins off and sells. Probably the best known one is Juno, which is the website which he sold off. And he sold another one off to Merrill Lynch for their computer trading department and so on. And if that's not enough, he's got a hobby which is applying computer science to development of drugs. And so he's got two companies where he's involved heavily in that, and he's reading all the periodicals in that industry. And if that weren't enough, when Clinton was president, he was advisor to Clinton, and he chaired a committee on education and science. And you think, and I asked him if he ever takes vacation. He says, well, not really. And if he does, he gets, after 3 hours, he has to go back to work. That's David Shaw. And he's really kind of typical of the person that is really successful. And I said there's really lots of types of examples. I'll give you another example. John Bender, who's an options trader I viewed in the last book. He would be trading options both in the U.S. markets and the Japanese markets, and he would be up and trading and watching both of those markets. So, and they're completely different. They're 12 hours apart. So, you figure out when he sleeps and does anything else. Okay, so that gives you kind of a flavor of what I mean by hard work. Now, the irony here is, why do most people get involved, or the general public, why is the general public attracted to markets and trading? Because it seems like an easy way to make a lot of money. And the irony is that people who are really successful are tremendously hard workers, and people are attracted to the markets because they want to make money easy. That leads us to the following paradox. You'll grant me that no sane person would think of going into a bookstore, going to the medical book section, finding a book titled How to Perform Brain Surgery, studying it, and going in Monday morning and believe that they could perform successful brain surgery. I mean, no sane person would think that way, granted. However, how many people do you know who would think absolutely nothing unusual about going to a bookstore, walking to the business book section, buying a book called How I Made $2 Million in the Stock Market Last Year, and think that after the weekend of reading this book, they can go in Monday morning and beat the professionals who've been doing it all their lives with all the support and all the experience they have? Right? I mean, it's really the same thing, but yet yet most people see nothing odd about the second approach. Why such a contrast? What's the answer? And there is an answer to the paradox, and the answer is this. Trading is probably the only world's profession where the rank amateur, the person that knows absolutely nothing, has a 50-50 chance of being right in the beginning. Why? Because there's only two things you can do. You could buy or you could sell. And some people are just going to get it right by probability, at least a few times in the beginning. And that beguiles people to think that trading's a lot easier than it is, because it is possible to get short-term success by pure luck. And that fools people. It absolutely fools people. Can't happen any other profession. You've never trained as a surgeon. The odds of you getting up and doing brain surgery successfully is 0. You never played the violin. The odds of you getting up in front of the New York Philharmonic and playing a successful solo are 0. Any profession you take, the odds of even short-term success are 0. It just so happens trading has this quirk to it that you could be successful for the short term without knowing anything. And again, it fools people. That's the whole point. Talked about trading being a lot of hard work. Now I'm going to tell you something that sounds contradictory. Good trading should be effortless. Right? So, kind of, what is this guy talking about? First he says hard work, now I'm telling you effortless. Okay. Here's the difference. The process, the preparation is where the hard work comes. The process should be effortless. I'll give you a running analogy. Let's say you picture two runners here. Well, not two runners, but two people. On one hand, picture someone who's completely out of shape, never has done any exercise, trying to run 1 mile in 10 minutes. Okay, have that image? And picture, on the other hand, a world-class runner running 1 mile after the other, easy as can be, 5-minute miles. Okay, who's doing more hard work? Who's more successful? Well, clearly the out-of-shape guy is doing more hard work. Clearly the world-class runner is more successful. But the thing is, the world-class runner didn't get there just by getting off the couch one day. He's been training all his life. So his hard work came into preparation. When he's performing successfully, however, the process, the actual process, that has to be effortless. And when he's doing best, when he'll run his best race is when he's really running effortlessly. When you're writing or when you're an artist or anything that's creative, when you're doing it best, it's almost flowing. In fact, it is that term flow is really actually a term that's come to be used. It's even the name of a book, which is a book actually worth reading. And it's true, that is true of trading as well. If it's not going right, you can't force it right by working harder. If your trading is just not working, if you're in a bad period, trying harder, it'll probably make it worse. You can't try harder. You can't work harder. You can work harder in doing more research. You can work harder in trying to figure out what's going wrong. But you can't work harder at trading. You have to probably at that point just ease back. Just maybe not trade. Maybe trade less. Because it's not effortless. And when you're trading well, it's not work. It's effortless. Again, difference between preparation and process. And I'll give you, there's an interview where this came up with this exact point. And people wonder how I get some of these interviews, and it's not an easy sell. But one thing I usually have to do is I have to tell people, look, I know there's nothing in it for you, but if you do the interview, I will show you the interview. I'm not going to use it. I'm not going to write anything that's untrue. I'm not going to sensationalize anything. And if you don't agree with what I do, then we can't agree how to modify the interview. Then we won't use it. And this kind of blows up in my face usually one time per book. Usually I'll have one interview. And I end up, in fact, it's actually happened in all 3 Market Wizard books. There's been one interview that I couldn't use for exactly that reason. And so this pertains to one of those interviews. I'm not going to mention any names, but there was one thing in that interview that I really wanted to use, and I said that, and the interview was one of these traders. Let me give you the background at least about what the interview is about. It was a very odd interview. This trader was into some unusual things. So in the interview, we got into dreams in trading, precognition in trading, Zen in trading, some pretty off-the-wall stuff. But it was an interesting interview. And I wrote it up, and I thought it was pretty good. I sent it to him, and a couple weeks later I got a call, and he says, I read the interview. And I said, uh-huh. And he said, it was interesting. I said, yeah. He said, but you can't use it. Why not? Well, turns out he had decided to also go into advising corporations on currency hedging. He had hired a business manager. His business manager read the interview. business manager read all the stuff about dreams in trading and Zen in trading and whatever. Not the corporate image. His business manager said no, he said no, and I was stuck. So I said, look, do me a favor. Just let me use this one little section, and we'll call it Trader X. And he said, okay. So that's why I have that 2-page section in one of the books. And the conversation goes something like this. He says to me, have you ever read Zen and the Art of Trading? And I say, well, I'm afraid I missed that one. And he says, no, I'm really serious. He says, just like in archery, whenever, and I'm going to quote him word for word, when trading, the analogy between trading and archery, whenever there's any effort, force, straining, struggling, or trying, it's wrong. And if you trade, you know those words are true, word for word. Yeah, good trading has to be effortless. Okay, now we come to the concept, which this one is not going to be new to you, but it certainly has to be certainly important, and that is, of course, money management and risk control. So let me just tell you a couple of slants of how the traders look at it. The best way of, I think the best summarization of it is Marty Schwartz. When he talks about trading and need for money management, he says you have to know your uncle point. I don't know if that uncle point is still that term is still used. I know when I was a kid and we fought, you know, one kid bends the other kid's arm behind his back, he yell uncle. I don't know if kids do that. I don't think kids do that anymore today, but whatever. But that's what you have to know where you yell uncle to the markets. That's his point. Bruce Kovner, who at the time actually still a huge trader, one of the most successful currency traders ever, and takes huge positions. I mean, even when I interviewed him, he was trading about $1 billion. I don't know what he trades now, probably multiples of that. So he takes such large positions. He says, whenever I take a position, I know where I'm getting out before I get in. And he said, otherwise I couldn't sleep. And the key point there is, by knowing where you get out before you get in, you make that decision when you have objectivity. Because once you're in the position, you lose that objectivity. And he basically decides where should the market not go if he's right. And he decides that before he puts out a position. I think it's a very good way to operate. Now, money management doesn't have to be really complex. I know there's been books written out there just on money management, and sometimes multiple volumes on money management. But you know what? A simple rule like risk no more than 1% on a trade will get you 90% of the way there. Most of money management is just doing it, just having the discipline to do it. It's not the complexity. There's no rocket science that's required here. It's just that you have to have the discipline to do, which I'll get to in a minute. Now, as far as money management goes, there's some other slants I guess are worth mentioning. Steve Cohn, who's probably one of the world's best traders, and he also hires other traders. And I interviewed him, he has like 50 other traders there. And so he's also not only trading himself, but he's monitoring other traders. He told me like the best trader that he has, the highest win ratio was 63%. 63%. That's the highest one. And he says the point is that most people, even good traders, lose a large percentage of the time. And you have to be prepared for it. And he says if you're in a position and you're not sure what to do and it's going against you, he said cut it in half. And if you're still not sure, cut it in half again. And all of a sudden you're down to a quarter of the position and the large part of the problem's gone. The point is just cut it in half will get you out of a lot of trouble in a crisis situation like that. All right, now money management, also in this idea of volatility and risk control, it's, we all here, some of us are traders and some of us are investors. I guess we probably all are investors in some role. And in that, it's very important. It's a very important theme here which relates to the investor side. And that is, a lot of people think about volatility when they're investing, whether, they take higher risk investments, whether it's with a manager or with an individual equity or whatever it may be. And they'll say, oh, well, I'm willing to take the higher volatility because I'll get that higher return. And I can take it. I'm tough. I don't mind the 30-40% drawdown. If I can get that 50 or 60% return, I'll live through the 30-40% drawdown. Well, you know what? They won't. I've been there. I mean, I've worked for brokerage firms for over 20 years of my life. And I've sometimes in the role of looking at managed accounts and analyzing what happens. And I can tell you at one time when I did the study at one brokerage firm, when I was kind of working towards picking different CTAs for the firm and monitoring them, I did a study where I looked at the results. There was a statistic that was reported, which was the percent of investors who closed out their accounts at a profit. And I remember quite clearly seeing a number of times that the CTAs had less than 50% of their accounts closed profitably, even when they had all winning years. think about that. That's because, what are they doing? What are the investors doing? They're going in after the CT has a good run, and then they're dumping it on a drawdown. People who say they can stand a 30% drawdown start sweating bullets at 10%. That's the reality, and you have to be aware of it. And the importance of that is that you won't be around, that investors are not around to get, even if the manager comes back, or even if the investment comes back, they're not there to realize the gain. So that 50% return, that 60% return, it won't be there because what happens is people get out during the drawdown phase. And instead of a 50, 60% return, they end up actually with a net loss in many cases. So that is the real danger of volatility. Now, I'll give you a story that relates to that. It concerns a hedge fund manager who unfortunately passes away. And the story starts with a minister who precedes him. And the minister finds himself at the gates of heaven and is met by St. Peter. And St. Peter greets him and he says, "Name." And he says, "Reverend Charles Smith." And he looks it up and he says, "Okay. Tell you what, why don't you sit there?" And the minister looks off to the side and there's this wooden bench. He's a little bit confused. He's expecting to go right in. He says, "Oh, all right." And he wanders over and sits down on the bench. And he sits there for a few hours. Up comes another man. St. Peter says, "Name?" And the guy says, "Robert Wilkinson." "Robert Wilkinson, yes, I see. You're that New York heart surgeon. Sure, we've been expecting you. Please, come right in." And the doctor goes in. A few hours pass, the minister's watching along. Up comes another guy. St. Peter says, "Name?" And the fellow says, "Michael Murphy." "Michael Murphy, you're the farmer from Iowa. Yeah, we were expecting you. Hope you enjoy your stay. We're delighted to have you. Please, come right in." And the farmer goes in. Minister's watching, doesn't say anything, but he's growing a little impatient here. A few hours more pass. Up comes another fellow. And St. Peter says, "Name?" And the person says, "David Stevens." "David Stevens, yes, the hedge fund manager from New York. Sure. I'm glad you're here. Please come in." All right. At this point, the minister's patience is gone. He walks up to St. Peter and says, Okay. The doctor, I got that. He saves lives. He goes in. Sure. I understand. Makes all the sense in the world. The farmer, all right, honorable profession, hard worker, helps feed people. I can understand that. He goes in. But the hedge fund manager, how come he waltzes in and I get to sit on a hard bench? And St. Peter says, I was trying to be tactful here. Didn't want to say anything. But the truth is, when you gave your sermons, your congregation slept. Up here we go by results. When he traded, his investors prayed. Okay. So you'll remember the importance of avoiding volatility. Okay, next theme is independence. Should come as no surprise that these people who are very successful as traders are independent. Michael Marcus says it very well. He says every trader has to follow their own light. He said you could take the world's two best traders and put them together and then you get the worst of both traders. And he's actually thinking of him, when he's thinking of two good traders, he and Bruce Kovner worked together for a while, and they were indeed two of the world's best traders. And he's saying no matter how good the trader is, if you try to combine methodology or try to combine opinions, you'll get much worse results. And I can tell you my own experience. I'll tell you actually a true story that relates to this. And it's absolutely true, because it sounds, when I tell you this, I know you're going to think that I'm maybe tweaking it a little bit to make it fit, because it fits so perfectly, but I tell you, all the events are exactly as they occurred. And this was back quite a number of years ago. I was trading my own commodity account, and I had done okay, but in the last few months, I had actually had a poor period, and I was down money, and I had kind of cut back my positions. I had maybe one major position left, and there was one of the traders that I interviewed that would call me periodically. And he calls me that day, and I'm not going to mention names who it is, but for whatever reason he would want to know my opinion. I used to be a technical analyst as well, and he would like to know my opinions on the market. Maybe he's much better trader than I was. Maybe he was fading me, I don't know, but he just calls me for my opinion. So we go over the markets, and he gets to the Japanese yen, and that happened to be the one trade I had on that I had any confidence in. And he says, "Well, what do you think about Japanese yen?" He said, I said, it's had this real sharp decline, and it's gone into this tiny little consolidation. And my experience is when you have that combined pattern, the market usually goes down again. And he says, no, you're wrong. And he gives me 80 reasons of why this oscillator is overdone and this one's overdone and this is, this technical indicator is this way. Gives me all these reasons why I'm wrong. And I say, you know what, you're probably right, but it's just an opinion. So I hang up the phone. Now, I'll tell you, even back then, this is like 10 years ago, I knew enough not to listen to anybody's opinion. But here's the thing. I had a trip out. I had to leave to Washington, D.C. that afternoon. And I was going to be gone for a couple of days. And I knew I couldn't watch the markets. So here comes my rationalization. So I said, okay, I've not been doing so great lately. I've got one significant position left. Do I really want, I'm not going to be here to watch it. That's the whole, here's the rub. I was not going to be here to watch it. That gave me my out. Do I really want to fade one of the world's best traders? So after hours, the market's closed already because I didn't get out after I spoke to him, but afterwards I said, well, maybe I should get out. So I walk over to the after hours desk, I put in the order, I liquidate my position. Okay, I'm sure it's not going to be any surprise to anybody in this room. I come back a couple of days and the end's down 200 points. I mean, I'm sure you expected me to tell you that, and that's what happened. But here's where you have to believe me that this is exactly as it happened. Turns out he calls again that day. And I wasn't going to be so ghosted, let's say, ask him directly, well, what about the yen? So we're talking, and he's going, he asks different markets. I don't raise the yen at all. Then he says, he talks about the yen. Ah, yes, I said, I played dumb. I said, oh, yes, the yen. Are you still long? And he exclaims over the phone, long? I'm short. What I didn't tell you is he's a short-term trader. I mean, for him, a long-term trade might be a day. And for me, a short-term trade might be 4 weeks. So when he talked to me, he indeed was bullish. He was looking for a bounce. The market probably didn't act right. Decided he was on the wrong side, took his 5-point profits, went short, made 200 points. I was right all along, got nothing. The point is, if you listen to anybody's opinion, no matter how good they are, no matter how smart they are, I guarantee you it's going to blow up in your face. You just cannot get ahead by listening to other people's opinion. You have to generate your own ideas. Okay, next question of confidence. One thing about doing interviews, I don't know how you are to watch interview shows, but I'm one of these people, sometimes I kind of swivel in my chair because they don't ask the most obvious question. I don't know if you ever have that feeling, but I do. I mean, there's some exceptions. I think Ted Koppel is terrific and Charlie Rose, they ask the right questions. But you have a situation where you're doing the interview, like I'm doing these books. I'm going to ask what I think is the most obvious question. If you were in my shoes, what would be the most obvious question that you might ask these traders? Now, I don't know what it would be to you, but for me, the most obvious question is, you made all this money. Why risk it? Why not just bank it, put it in the bills, retire, go home, call it a day? I mean, it doesn't seem to make any sense to keep on doing it. And the answer I get, in one form or another, well, the best, let me give you just one answer to this, would be Paul Tudor Jones. He said, well, I keep 85% of my money in my own funds. Why? Why? Because it's the safest place for it. This is from a futures trader. So in his mind, keeping money in his own funds is safer than T-bills, or as safe as T-bills. What does that tell you? It tells you the guy has a lot of confidence. And Monroe Trout goes in one bet. He puts 95% of the money. And now that I'm running fund of funds, and a lot of managers that I'm interviewing, they have 100% of the money. I mean, one guy had like 100% plus his home equity. I mean, these people have, which is always good to know, but these people have a lot of confidence in what they're doing. And which comes from, I mean, are they successful because of the confidence, or are they confident because they're successful? It's kind of a hard question to answer, but I can tell you this, that the one way to gauge it is whether you're going to be successful is whether you really have confidence. And often I'll speak to traders, and they, trying to find a methodology, or they're unsure. But I could tell them, if you don't know that you have the confidence, if you're not sure, or just about sure you're going to win, then you're not there yet. And you have to be aware, and you have to go much more slowly. And only you as the individual can decide or know when you have the confidence. But I can tell you the traders are really good. They exude that confidence, and you just know it. Okay, related to confidence is this idea, and this is a little bit less, this is not so common. This is one of those ideas that you don't really hear, and it's very important to understand, and that is that losing is part of the game. Now, let me illustrate that with a comment by Linda Raschke, who's probably a lot of people in this room, more people in this room will know Linda Raschke, I think, than most audiences I speak to. But Linda Raschke started out as an options trader on the floor. She had a horse riding accident and then ended up having to trade from an office, and she became quite successful trading from an office, and she's done both of them quite well. Linda said to me, "It never bothers me to lose because I know I will always make it back." Never bothers me to lose because I know I will always make it right back. Now, doesn't that sound like an arrogant comment, an egotistical comment? But if you know Linda, she's a very modest person. She's very soft-spoken. She doesn't make anything about what she does. That's not her at all. All she's saying is this: I've got a methodology. It's going to win in the long run. Along the way, there are going to be some losses. As long as I stick with the methodology and keep doing what I'm doing, I'm going to come out ahead. If I lose now, I'll win subsequently, and I will come out ahead. So that's all she's saying. She's saying that losing is part of the process, and you have to understand that. Dr. Van Tharp, who I interviewed in my first book and spent his career interviewing traders and counsels traders, and he's kind of doing professionally what I did in my books. He had this comment about the traders he found most successful. He says all successful traders that he interviewed, the best ones, know they've won the game before they start. Now, if you know you won the game before you start, then there's no problem taking a loss, because you understand that that's just part of the way of getting to the ultimate game. Marty Schwartz had a really interesting way of putting this whole concept about losing being part of the game. He said, "What is the rallying cry of the losing trader? I'll get out when I'm even." Okay, think about it. Why is getting out even so important? Because if you get out even, you could say, "I wasn't wrong, I didn't make a mistake." And that need not to be wrong, that need to fulfill the ego, to be right or not to have made a mistake, is exactly why people lose. So the irony is, people lose because they don't want to lose, or they don't want to take a loss. And the professional traders understand that to win, they've got to take losses. That's part of the process. So that's why I say it's a very important concept to understand. Losing is part of the game, it's part of the process. There's a book written about trading, probably the most famous book ever written about trading, called Reminiscences of a Stock Operator, which many of you probably have read. Some people mistakenly think it's about Jesse Livermore, and it's written so realistically, and it's written in an autobiographical tone, that most people believe that Jesse Lefebvre, who was the author, was really Edwin Lefebvre was really Jesse Livermore, and it's a pseudonym. But in fact, there was Edwin Lefebvre, who was a journalist who wrote this book, and it wasn't just Jesse Livermore. He just did such a good job that people think it was Jesse Livermore. But in that book, there is a line that goes something like this. It basically says that there is the fool who does wrong at all times, but then there is the Wall Street fool who thinks he must trade at all times. So it's roughly paraphrasing it. And the idea is that you have to really wait for the opportunities. You just can't try to trade all the time. Jim Rogers has a good way of putting it. He says, "I just wait until there's money lying there in a corner of the floor, and all I have to do is walk up and pick it up off the floor." You know, in other words, until something is so obvious, until a trade is so obvious that it's like taking money off the floor, he does nothing. What does that say? It says patience. Patience is essential to good trading. Another trader had this way of talking about patience. He said, he used an animal analogy. He says, the world's fastest animal is a cheetah. But what will the cheetah do? It won't just go chase after any antelope. It'll wait in the bush for a week until it sees a baby antelope, and preferably a lame baby antelope, and then it'll strike. And he says that's the epitome of a professional trader. So it's, again, waiting for the right opportunity. Now, closely related to patience and getting into a trade is the idea of patience and staying in a trade. And it's going back again to Reminiscences of a Stock Operator. He has another quote. He says, "It was never my thinking that made me the money. It was my sitting." Got that? My sitting. What he was saying was, look, it's not that I was a genius and was able to figure out all these great trades. But what I was good at is when I was in the right trade, I stayed with it and stayed with it and stayed with it. And that's where the profits came from. That's what was essential. So it's what I would call the importance of sitting. I go to a fellow by the name of Bill Eckhart, who talks about this subject. Eckhart may not be that familiar name. He was Richard Dennis. Everybody knows Richard Dennis. Eckhart was Richard Dennis's partner, and when you read about the turtles and the turtles being trained and so forth, it was both Dennis and Eckhart who trained the turtles. It wasn't just Dennis. And Eckhart is a PhD mathematician. He's done quite well as a CTA over the years, and he talks about this concept. He says there's this adage, this Wall Street adage that you never go broke taking a small profit. You know, probably heard that one. And he said that's a really wrong-headed approach. Amateurs, he says, go broke taking large losses. Professionals go broke taking small profits. The message is, whatever your methodology is and whatever represents long or short, you have to allow the good trades to work to their reasonable fruition if you want to pay for the losing trades. So again, the importance, patience both in getting in and getting out. Next we come to the subject of loyalty. Now loyalty is a good trait, right? I mean, it's, you want loyalty in friends, family, pets, nice trait. As a trader, it's exactly the opposite of what you want. You don't want loyalty as a trader. The best example I can give you concerns Stanley Druckenmiller. Stanley Druckenmiller, oh, and the date of this example, I'll give you the exact date. The exact date of this example is October 16th, 1987. October 16th, 1987. For those of you who are scrambling, I'll give you a hint, it's a Friday. Okay. On that day, Stanley Druckenmiller, he was at the time, Stanley, by the way, probably you know Stanley, but he managed to, he worked for George Soros for many years, and for many years ran the Quantum Fund. Even though people associate the Quantum Fund with Soros, for a large part of that time, Soros was spending most of his time in East Europe and the Soviet Union, trying to get those countries over to capitalism and so forth. And the person who has really had his hands under control day in, day out was Stanley Druckenmiller. He's also run his own fund for 20 years and done terrific. And before he went to Druckenmiller, he was running multiple funds for Dreyfus. And this is at that time he was at Dreyfus. So he came in that day and he was net short. Nice position to be in October 16th, 1987. Unfortunately, if you remember, a lot of people think of the market broke. They forget that the market was breaking sharply prior to that day, prior to the Monday. And particularly on Friday. Friday was also a very ugly day. The market was down a lot. And he decided, you know what, it's kind of getting down, 2,200 I think was the level it was coming down to. I think he said that's enough, the market's going to be near support. So he took his profits, but not only did he take his profits, he decided to go net short. I'm sorry, net long, net long. Now I used to ask audiences, anybody here ever make a worse mistake than going from short to long on October 16th, 1987 in the US stock market? Okay, the reason I stopped asking that question is because I realized I couldn't make up a worse example. I don't think you can make up a worse example. The amazing thing is, if you look at his record for that month, it'll be about break even. Now, how is that possible? Well, first of all, first half of the month he was short, so he made money. Now here's the thing. After he put on a position on Friday, during the weekend, he decided he had made a mistake. He decided he was wrong. Why we won't get into it, it's not important. You can read it in the book if you want to know why. But he was sure he was wrong. So he decided he was going to get out Monday morning. Unfortunately, Monday morning comes around and the Dow opens over 200 points down to begin with. But what he did that Monday morning was, in that first hour trading, he covered his entire position, and get this, he went back short. Now think of the amazing flexibility, and then we're talking about a fellow managing, I guess, probably over $1 billion at the time, to be able to reverse his position again after the market has gone down that much overnight. That's a tremendous flexibility, tremendous lack of loyalty. It's a classic example of a professional trader. So if you want to be a good trader, you can't have loyalty to your position. There's no hoping, there's no anything. You've got to be able to react immediately. You can't have loyalty to your position. We'll come down, we'll have a couple of last points before we finish. I guess we're just about done. One other point I would like to make, which is a point that goes back to Eckhart, and has to do about people's human nature in trading. And Bill Eckhart has an interesting comment. He says that people are so poorly attuned to trading that they will do worse than random. Now, you know the academic comments, every now you'll see the academics say, well, you can take a monkey and give him darts and put up a page of the Wall Street Journal, let the monkey throw darts, and the monkey will do as well as the professional money managers. Okay, You've all heard something like that, I'm sure. Now, Bill Eckhart, so there's no confusion here, Bill Eckhart is not saying that. He's not saying the monkey's going to do as well as the professional money managers. He's saying the monkey's going to do better. That's an important distinction. Now, why is the monkey going to do better? The monkey's going to do better because humans have evolved in such a way that they are particularly poorly attuned to trade. Humans seek comfort, whether it's food or shelter or sex or whatever, it's comfort. And you know what? Markets don't pay off for being comfortable. His point is markets pay off for being uncomfortable, for taking the uncomfortable position. And most people don't do that. They seek comfort in their trading as well. And that's why he says they're going to do worse than random, that you would literally, for most people, would literally make better choices if they threw darts. And examples of easy to find. Look, if you're in a position that's going against you, let's say, and you say, oh, well, I'll get out, but I'll give it another 3 days. You know, oh, good, I got another chance. Feels good. It's usually the wrong decision. Or you're going to buy some stock or whatever, and it's you're buying it, let's say, at a lowest point it's been in the last 6 months. Kind of feels good because you're smarter than everybody else who bought that stock in the last 6 months. So yeah, boy, aren't you smart? You got the best buy in the last 6 months. Feels comfortable. So a lot of these trades that are done, which come out of an emotion of seeking comfort when you get right down to it, are going to end up being wrong. It's also, by the way, for those of you involved in trading systems, this leads a lot of people to go wrong in developing trading systems. Because what do people do with trading systems? They will optimize and optimize and optimize until you get a really smooth curve. Now, doesn't that feel good to trade? Boy, you've got a curve here that's never lost in any given month, and that feels a lot better to trade than some trading system that has some wiggles to it. And the more you optimize, the smoother you get it. But the more you optimize, the greater the chances the system won't work at all. But again, it's part of this human nature seeking comfort. So we'll finish off this by one last point and then one last story. The last point is, look at the language of traders. They talk about, I've heard the description of talking about trading as a three-dimensional chess game, as Bruce Kovner's line. Jim Rogers talks about 10,000, it's like a jigsaw puzzle of 10,000 pieces, and they're always throwing in new pieces, taking out some pieces and throwing in new pieces. Another trader talked about trading being like his chart book. He passed his chart book. He says, it's like a treasure hunt. He says, every week I go through this and I look for new treasure. And what are those? Those are all game-like analogies. And that tells you something. It tells you that to them, trading is almost like a game. It's something that's fun and something they love to do. And that's the essence of it. Whether it's trading or anything else, I guarantee you, look around people in your life who are successful. And the one thing I'm sure of is they love what they're doing. It's true of trading, it's true of anything. And unless you have that love and passion, you're not going to be successful, and it's essential to be successful. So I finish off with the last story, which is just a personal thing, which I've given this talk, I really have given this talk a lot of times. I used to give talks on lots of different stuff, even fundamental analysis at one point, and certainly a lot of stuff in technical analysis and computer trading and all that stuff. But basically now, almost all the time, I'm giving talks on market wizards and this particular theme we just discussed. And there's a story which I like to talk about, which is about an economist who is in a similar situation as I am, and he's being driven to give a talk to an international audience, and he's being driven by a chauffeur, and he's in the back of the car, and he kind of sits there and he moans, and the chauffeur asks him, sir, what's wrong? And the economist said, I can't stand to give this talk again. I must have given this talk 200 times. I'm just bored to death of it. And the chauffeur says, you know what, no problem, boss, I'll give the talk for you. And the economist says, well, how could you give this talk? This is a highly technical, sophisticated talk, and the audience is filled with all these PhD economists. He says, boss, I've heard you give this talk 200 times. I know it word for word, trust me. And he figures, what I got to lose? So he puts on the chauffeur's uniform, the chauffeur puts on his suit. The chauffeur gets up in front of this audience of economists, and he gives the talk for an hour. He delivers it perfectly. But then he gets carried away. And he finishes his talk and he says, any questions? And he gets a question and he actually manages, and he gets another question, he does okay. Then he gets a question and the fellow, I was very intrigued about your theory of synthesizing classical Keynesianism with monetaristic theory. My question is this, if you put it into the standard econometric framework, do you treat the monetary variables as exogenous or endogenous to the model? Chauffeur scratches his head and he says, you know, I've given this talk 200 times, and that has got to be the single stupidest, dumbest, most ridiculous question I've ever heard. In fact, it is so dumb. I'm glad my chauffeur answered.